All right, we have Sean here. Hey, Sean. I'm sorry, man. I'm about to go through the roof. I'm actually recording this, the experience I just went through, because I'm going to be ripping their effing heads off in the morning. I'm hoping for a couple other people to get in here. We have Andre. Hello, Andre, from Quebec. My friend from Quebec. Gary, welcome. TZ Burton. What am I saying? TZ Burton. All right, people are slowly populating in here. Guys, I really apologize. I'll give you the my audio's not good. The audio's not good. Can you hear me okay? Let me check my audio. Okay. I'm getting a mix of some people can't hear me, some people can. I'm going to make sure my microphone is accurate. I just unclicked it and rechecked it. I'll wait for a reply back. I don't know if there's a delay here. Let me go to the audio settings. Okay. I just checked the button, voice isolation. Is the sound better now or worse? I'm going to uncheck voice isolation. I'm going to do that right now. Does that sound better or worse now? Yeah, thank you, TZ Burton. But this is actually not the first time. I went live on Friday afternoon. Franklin was there, and here's what happens. I'll show you on the back end what it's like, so you understand what I do. So you can see here. Here's the event. I sent this link out to you guys. It's still saying I'm live, but I'm not. So when I go in, I look for a way to start the video. Now it's letting me join now. There's no go live button, but it shows me I'm being live. So I had to get out of here and create a new video, which is really, really irritating to have to do. Not for me per se, but for the irritation that you have to go through. So, all right. So yes, this is the beginning stages, growing pains, but we are here. And I would encourage everybody to please head on over to the poll and enter your requests in there for stock charts request. For those of you watching this on the replay and you wanted to see this go live, I think I just figured it out. The stupidest thing in the world. I think I just figured it out. Okay. If you're watching this on the replay, YouTube, Twitter, etc., and you want to join us live, which is always the best thing to do, use the link below, sign up for our new trading platform, and you'll get us live, get stock chart requests, etc. And there is no charge. We have a great group of folks here, very, very professional, and we've had a lot of people sign up. And for those watching on the outside looking in, so what we want to do is, before we go live, enter your quotes here, the symbols that you want. Sean's there. And please enter your symbols there. That way I can go over and I don't miss any of them. As a matter of fact, I think I missed a couple from Friday afternoon. And yes, we will get to where's the poll? All right, so I thought I missed a couple from Friday. I thought TLE was one of them. Lily. I'm going to go over TLE because I'm pretty sure somebody requested that. And I didn't get to it. So let's begin here. Let me share my screen. And again, I apologize, folks, for all of the glitches tonight. We'll work them out as we've done on other platforms. And happy Labor Day. Happy Labor Day. Let me share my screen. Let's get to it. Okay. Let's take a look at the futures action. And we have a lot to go over tonight. Today, the stock market was closed. However, yields, bonds were being traded, and the futures markets were up today. And a very, very significant event happened today, and we need to pay close attention to it because it is very, very serious. So let's get to the futures action first. Oh, that's cool. You're watching this on the phone. Very, very cool. I wish I could click on the comments and have them share on the screen. Okay. People slowly still filling in here. Good stuff. All right, let's kick it off with the E-minis. E-minis are up 0.04%, and they were up earlier today fractionally to the NQ, NASDAQ 100 futures. They were open today. They closed up fractionally on the day. Now, the NQ, this is a 30-minute chart. Let's do a deeper dive here. And you can see that we are fading. So the question really that we have for the beginning of this month was Friday's very aggressive buying into the back half of the trading day, was that a month-end markup? Were portfolio managers painting the tape on their results for the month? As it stands right now, it looks as though we have a bit of a fade off the highs of the session. We are down at current, and we'll take a look at the E-minis. And the E-minis are up 0.18%. This is a follow-through on this afternoon's session. They're considering this all one trading day. Remember, it's still Monday on this chart. Normally when we go live, it's Friday's closed, then we go into Monday's open. This is still Monday. So it's showing that we're off the highs of the day, but we're still up net on the day. Now, we do have shorts on the NASDAQ 100, and I am worried about a continuation follow-through on the NASDAQ 100. Trader Isaac, you are in the room, my friend. Very thin trade at current. Let's take a look at the Dow Jones. Dow down, it's down 0.12%. Interesting. My guess is we have dollar up, yields up, given the fact that we have the large cap tech names up. Let's check in with the Russell 2000 small caps. They are down. I'm gonna guess that we have dollar up, yields up, and that's influencing trade. Yeah, at current, we have the 10-year yield up over a third of a percentage point. And we have the dollar is up as well. So that's influencing money flows at current. Remember, the correlation here is this: yields up, high tech up, yields down, mid cap, small caps up, and the Dow up, because the Dow Jones, they export manufactured goods. So what happens when the dollar goes down? Our goods become cheaper overseas. So that makes us more competitive. So when the dollar spikes up here, you got money that leaves the Dow Jones Industrial Average. Now, looking at crude prices, they were up on the day, but man, have they tanked. They're still up, but this is a pretty nasty sell-off here that we're seeing. So I'm not a buyer of oil right now. And I believe, if memory serves from earlier this morning, Nat Gas had a good, at least open. I don't know how it closed. It's still up over 2.33% on the day, but coming off of its highs. So, I didn't trade today. I could have traded the futures, but I put in a space here called health and fitness. And I don't want to come off by any stretch of the imagination as being a fitness guru. I am not. But I do believe that health and fitness is critical. So even more so than working out your body is just resting your mind. So I'm going to be working on this in the coming days and weeks. In fact, probably sooner than what some may be thinking about, because it's Labor Day. Labor Day is over. And I have a strategy for dropping weight, building muscle. And for anybody that's over 40, that's not a easy challenge. But I will be doing it, and I'll be very, very public about it. So more to come on that. I don't want to get off into the weeds here. But mental fitness, when it comes down to trading, is paramount. So I didn't trade. I knew it was light volume, and I wanted to give myself a rest. So Nat Gas coming off of its highs, but still up on the session. Let's take a look at gold. Gold is up fractionally. I'm not a buyer here. I'm not a buyer with a strong dollar. Gold is probably still going to come in some. There will be a time where I'll be far more bullish on gold, but now is not the time. Taking a look at silver. Silver down 0.75 of a percentage point. No great shock after last week's close. Let's move on over into agricultural land, taking a look. Wow, look at this. Corn ripping. Nice. Oh, this is a breakout. I want to check the seasonality of corn before we log off. So when we go to chart requests, I'm going to make a note to myself. As a matter of fact, I'm going to do this. Growing pains. Sorry, folks. Growing pains. All right. Mr. Sean. Corn. Go over. All right. Note to self. Okay. All right, so I got to tell you right now, this is a beautiful, beautiful breakout on corn. And the thing to keep in mind is that this is last week's candlestick. This is not today. It's last week's. So this is in the books, the week of the 26th. So corn looking really outstanding here. Soybeans also looking good. Continuation breakout last week, down at current. I want to go back to soybeans. Wow, look at this. Oh my goodness gracious. Look at wheat. That's an outside reversal bar on wheat, bullish key reversal. Call it what you want, call it cupcakes. Let's clear all this junk off. We're buyers of wheat. Beautiful. Beautiful. Let's go intraday to see how it's performing. It's going up. Very, very nice. Really good stuff here. Let's check out soybeans. Our intraday double top here, I would avoid it at current. Nice little rally back off the lows. Looks suspect though. So I would not be a buyer at current. Let's take a look at what else. Copper. Copper bidding here in the after hours session. It's down on the day, but it's bidding in the after hours session. Let's take a look at the weekly chart of copper. Materials began to rally. If you go to a chart at BHP Bulletin last week, looked pretty good. It's been a laggard, but keep in mind what they're going to do here is they're going to cut rates. What is the outcome of that? They're going to kill the dollar. And what's that going to do? It's going to stoke the flames of inflation. They know they're going to do it. They just don't want you to know that they're doing it. You do know it, but 99.9999% of the American public is oblivious to what's happening here. Loving corn here, copper looking good. I think we have a higher low. We've broken out of a secondary downtrend. Here's our primary upper band of resistance. So the commodity play, and I read somewhere on Twitter that we're at historic lows in terms of the value of commodities relative to equities. And I believe it, because when you take a look at the Buffett indicator, we're going to go to it in a moment. I'm going to show you the chart. We're like at historical levels overbought on that indicator. We're at 190% of GDP. It's bananas how overbought this market is, or how expensive I should say that it is. I think we covered enough here. Did we do Aussie dollar versus Japanese yen? That came into play in the back half of the week. It is down at current. Let's go to a 15-minute view. They're pressing it lower. What are they doing with the NQ? They're selling it off. Do not ignore the Aussie dollar, Japanese yen trade. This is the pairs trade. If it gets weak, there's a very good chance that the U.S. equity markets are going to get weak as well. There's a very strong correlation. Not as strong as it was in early August, but on a long-term view, that correlation, like using a monthly charts, around 75%, 80%. So it's best not to ignore the correlation. So if Aussie dollar, Japanese yen goes down, very good chance U.S. equities go down as well. Why? No idea. I think it would be more important Aussie dollar Japanese yen versus U.S. dollar. I should say U.S. dollar versus Japanese yen. But let's check out that correlation. I don't think I'm going to get it. PY. Oh, they did do it. Dollar down fractionally versus the Japanese yen. All right, I don't want to spend too much time on this, but you get the drift. That watch that Aussie dollar, Japanese yen trade. If it's moving lower, beware of how much risk you have on in the U.S. equity markets. Let's get to, and before we leave here, always at the beginning of the trading day, I try to repeat this a couple of times. Trading is merely a game of the patient taking money from the impatient, finding the right balance of patience and determination. Very, very important. Now I got to find my tabs for the show. And here we go. All right, let's kick it off. What a night. What a night. I'm telling you, I'm going to be on the phone with, I pay a lot of money for the software. I'm going to be on the phone with them, hammering them tomorrow. Thank you for your patience again, folks. Okay, so here's the data that's coming out this week. And we have, obviously, the holiday weekend is over. Tomorrow, being Tuesday, we have the S&P 500 U.S. manufacturing PMI. We get construction spending. We have ISM manufacturing coming out. They're expecting a negative read. For folks not familiar, any read above 50 is a sign of contraction. Any read below 50 is a sign of, any read above 50 is a sign of expansion. So they're expecting a negative read. U.S. trade deficit, nobody cares about it. The crash of 1987, they cared about it. Now, no big deal. Job openings, watch this one, folks. Very important number. Very, very important number. Factory orders, important. Fed's beige book, important. Thursday, all right, so as soon as you see ADP, well, then you know you know it's jobs week. And I always call the U.S. employment report or non-farm payroll, which comes out on Friday, the pimp Mac Daddy of all economic data. Now, I meant to bring it up, and we didn't have much time to go over it anyway, but the U6 number, not the U3 report that like to spoon feed everybody, is the number that you should be watching. The U3 number is the one, the headlines that'll be reported by CNBC, by the Mockingbird media. That's the number they're going to report. They're not going to talk about U6. That counts in people that have dropped out of the workforce and no longer are looking for jobs or are marginally attached to the workforce. Now, here's the problem for the mainstream Mockingbird media. All of those reports, U3, U6, are now going up. That's a problem. And that's why you've seen the equity markets rally on not horrible initial jobless claims these past few weeks. So this is a weekly report. This is not going to negate monthly reports that have been released with negative numbers, rising unemployment for now over 3 months. So I don't care if you get 4 or 5 of these in a row, it's going to have very, very little influence on a 6-month view of the unemployment report. On Thursday as well, a lot of economic data coming out this week. U.S. productivity, that's important. Services PMI, that's another revision along with the manufacturing. We get that early in the week, the manufacturing. ISM Services Index for August, that's expected to be 51%. Again, folks, any read above 50 is contraction. Any read below 50 is a sign of, let me rephrase that. Any read above 50 is a sign of expansion. Anyone below that is a sign of contraction in the economy. Now, what do we expect? What if we come out with a number that is below 50 on ISM services? I think the response needs to be, a qualifier needs to be, by how much? By how much? If you come in at 49, I think what happens is that the probability of a rate cut goes from a 1/4 basis point cut to maybe a 0.5 percentage point cut. If it comes in abysmal, then things get really, really wonky for the equity markets. And I'm going to tell you why in a moment. Now, looking at the Friday data coming out, we get, the Pimp Mac Daddy of them all, U.S. employment report. Remember, they've revised this report down over 800,000 jobs over the past 12 months. Unemployment rate, this has been ticking up. Average hourly wages, they don't want this to go up. They don't want you making more money. Why? That's inflationary. They want you taking home less, as sick and perverse as that is. So the last thing you want to see is this, is unemployment rate going up along with U.S. average hourly wages. That is probably the worst nightmare for the Federal Reserve. You have wage growth rising along with the unemployment rate. What do? Because if wage growth is rising and you're getting a rally back on commodity names now, well, what do you fight? Do you fight inflation or do you fight unemployment? This is the hole the Federal Reserve is going to have to try to bail themselves out of. But Jackson Hole, Wyoming, 2 weeks ago, Powell claimed victory over inflation. So if inflation comes back 6 months, a year from now, in earnest, like I expected it would, if they continue to cut these rates, then he's going to say, oh, well, we had it beat. It was going in the right direction. This is the new inflation, not the old inflation. This is the new inflation. We had to fight the calamity that we were just facing a couple of months ago, which is what we expect after the first rate cut. So we had to step back in and cut rates more to defend the economy, to defend jobs. But a year from then, he's going to be saying, well, we had to do what we had to do. We had to cut rates. But he's never going to go back. He's never going to go back to August of 2024 when he had the opportunity not to cut rates, and try to grow the economy organically. They could do that with tax cuts, not by cutting rates. They're never going to come back to the snapshot in time. Remember it. This was their opportunity. Not that the Federal Reserve can cut rates, but certainly Congress, and pox on both the Republican and Democratic House for this, they could have cut taxes. I'm fumbling here a little bit tonight because of the technical issues. So I'm off in the weeds. Let me get back on track. So a lot of economic data coming out this week, folks. And this is even going to be more magnified in a couple of minutes when I show you what happened today. Schiller PE ratio, we're at nearly 36.5. This is a rear view mirror reported basis. A lot of people don't want you, don't look at this, look at the forward-looking basis. Okay, we'll do that in a minute. Buffett indicator. The last time we went over the Buffett indicator, we were overvalued. We are now strongly overvalued. We've only been here a couple of times before, and the last time didn't end so well. That's when we went into the bear market. So here we are yet again, and sure, can we go higher? We usually do. We overshoot big. We come back down around to this one standard deviation move. The last time we were down at the historical trend, I mean, my God, that was back here at around 2012, around there, 2013. Now we're going to talk a little bit about forward-looking valuations. The S&P 500's peak earnings ratio has moved up to 25.7, its highest level since 2000 and 49% above the historical median. So we're expensive on a rear view mirror basis, on a reported basis, and we are also expensive on a forward-looking basis, folks. This is an expensive market. CME FedWatch tool. Thank you, Gary. Thanks for the comment. Again, I wish I could highlight these, but it doesn't let me. So Fed rate hike probability of an ease in September. We know that's not going to change. What really has not changed either is the probability of only a quarter basis point cut. So you have unemployment going like this. You have commodity inflation beginning to pick back up. Yet they're only going to cut by a quarter basis point. Is that too little, too late? That's going to be my guess. I think that if this market does come under a lot of pressure, I think it's going to be a sell the news event on a quarter basis point cut in September. Now, if he is going to politicize the office, what he'll do is he'll shock the market. He'll go with a half basis point betting that it will rally the equity market, helping the regime stay in power. Now, that's a roll of the dice because the interpretation by the market could be like, oh, whoa, we didn't expect this. We didn't expect it. What's wrong with the economy? So it's a roll of the dice. Headline news over the weekend, we have more attacks. I don't know what insurance company is insuring these vessels to go through the Red Sea. Oil tanker and merchant ship hit by projectiles as another tanker burns, risking worst spill this century. So much for the BP spill and the Exxon Valdez. They have it worse over there in the Indian Ocean. I don't see the greenies out there complaining over the Houthi rebels, because if the Houthi rebels ever got their hands on these Greenpeace people, look out below. I shouldn't say Greenpeace. I happen to like Greenpeace. They protect the whales. I mean the greenies, the Marxist greenies, the AOCs and the Greta Thunbergs of the world. More great news. We're on the verge of pressuring Russia into a no-win situation. Russia updating nuclear weapons doctrine meaning their policy, due to Western escalation of Ukrainian war. Over in China, I'm going to play this for you. So what this is that the Chinese have begun dealing with their oversupply of housing by blowing them up. So this is Jim Rickards. I happen to have a lot of respect for Jim Rickards. They got the GDP when they built them. Where's the write-off now? Great point. This is not just a story about 15 buildings. I remember, God, it's got to be almost 10 years ago, you had guy has a big nose, Greek guy, short seller. At least he used to be a short seller. Jim Thanos, short seller, very, very smart guy. But what he was reporting on his shorts, and the reason why he was short is because you had dozens of cities over in China, brand new cities, beautiful cities. They're empty. They're what they call ghost cities. So this is not a story about just 15 buildings and construction companies that have gone bankrupt. This is a story about their economy and how they goosed it. Remember, you had all the copper going over to China, all the commodities going over to China. They fueled global demand. Australia's economy was ripping until it didn't. They overstocked themselves with housing, and now they're dealing with it. So are they going to write this off of their GDP? It looks as though it's already begun because they've slowed down, but are they really reporting the right numbers? This is why I say China is uninvestable. China's economic success is a paper-thin fraud. It's now catching up with them. Agreed. We're going to go over here tonight, folks. We got a lot to go over. On the left, we have the great financial crisis of 2008. On the right, what do we have? What do we call this? Now, it's a great question. We've seen this before. I've shared this out. This is 500. Actually, it's about $500 billion worth of unrealized losses that are on the debt or the balance sheets of the banks here in the United States. This is what it was in 2008. Think about the mess they are covering up over the Federal Reserve. Off of the Kobisi letter, I'm not going to read all of this, but what I'm walking you through right now are the potential bubbles that are out there. Frankly, I didn't see the yen carry trade being an issue because the yen was so weak until it wasn't. Then it became strong. So we want to keep an eye on everything that we know and keep an ear open for what we may not know. And this here is really, really serious stuff. And he's right. This is unsustainable. I'm trying to see the time frame of this. This is expected growth. This is expected as of 2034. Okay. Net interest on the debt, 23%. Social Security, 30%. Medicare, 25%. Other health spending, 10%. Other spending, discretionary spending, only 12%. At what point in time do people not show up for our bond auctions? And you wonder why they're buying gold. Patrick Moore, founder of Greenpeace, is now an advocate for clean nuclear energy. That's good to hear. All forms of energy are good. Abundant energy lifts people out of poverty. Agreed. Northman Trader. Consumers sure keep not to be buying all of this. The economy is great and AI is awesome. Happy talk. Typically, bull markets see confidence rising in consumers, not this time. So what we're looking at here is the UMich Consumer Sentiment Survey, which is highly correlated with the NASDAQ. And I'm sure the S&P 500, whatever you want to overlay here, U.S. equities markets. Look at this bearish divergence, which began in 2020. We have never really broken out to new higher highs. It's been breakdown, rally, fail. Rally, fail. And here we are, very close to all-time highs, where we just had a major sell-off a few weeks ago due to the yen carry trade. It's just unsustainable. The question is when? Is it a month from now? Is it a year from now? That's the magical question. And I'm getting to the big Pimp Mac Daddy right now. So I talk about the yield curve all the time. And this is actually fairly old, this chart. This is the longest inversion since 1929 of the yield curve, 2 years versus 10 years. There are multiple different time frames for yield curve. We always use 2 years versus 10 years. It won't end well, of course, we know that. So why am I talking about this? I'm talking about it. Paul, welcome aboard, pal. I'm talking about it because the yield curve did something very, very significant today. Hopefully this has not changed. They closed it. The 2-year rose yet again versus the 10-year. It's not showing here because the markets are closed and StockCharts.com is not updating this because it wasn't live. So the yield curve, which is only one tick away from uninverting, uninverted today. So what does that mean for us? It means that we are now in the territory of when do we cross the Rubicon? When do we cross into the shaded area in gray where historically equities begin to roll over? Perhaps tomorrow they'll open down. Or the yield curve will open down. It'll buy us some time to the Fed rate cut. But this, folks, is extremely ominous for the equity markets. We were talking about this right before 2020. We were talking about the yield curve is steepening. Watch out for equities. Sure enough, we know what happened back then. Come on. M2 money supply. So this is money that is now being pumped into the market. You only see this generally in recession or just after because the Federal Reserve is too late. So 1960, 1970, you saw it back here, no recession to be fair. 75, 80, 82 actually. No recession here. They were late to the party here. That's around 2012. And here we go yet again. After years of declining, they're now pumping money back into the economy. Why? Liquidity. Liquidity. Gary or TZ Burton. I can't go. What do you want to be called? Gary or TZ Burton? I'm so used to TZ Burton. I stopped myself in the middle of saying your name. I haven't seen George Gammon in 2 weeks. He's always talking about the 2 and the 10-year inverting back, indicating recession. Yeah, because you know what? It's such a predictable measure of where we're at in terms of recessionary environment. We have the data right there, so I don't blame them. I do it myself. So, and I'm a fan of George. I haven't watched him in a while myself. TZ is fine. Okay, all right, that's cool. Thank you, TZ. All right, this is from JC Parrots. Um, Peretz. I always say his long name wrong. What are you doing with this information? So, what this information is here is we've kind of talked about this in the past. This is presidential S&P 500 during presidential election cycles. So obviously, the time frame we want to be concerned about is the one we're going into right here, right now. Now, JC is very, very bullish because you have the Vance decline line is breaking out. S&P 500 on an equal weighted basis is breaking out to new all-time highs. I don't argue with them, but usually you generally see all-time highs before you break. So as you move into the seasonally weak period of time, you could see that I believe that this is current election year cycle, last 5 years, last 10 years. And I don't know, this is probably, I don't know what this is. I don't know what the blue represents. But black is over the past 10 years, you didn't want to own stocks. Election year 5 years, you didn't want to own stocks. My argument is that, and I don't know what this is, you sure didn't want to own stocks there either, except it's less worse. So this is just another view of the seasonality that we're finding ourselves in. And another view of it is here. I've shared this out before, that the seasonality in September and even worse, October, over the past 25 years is dismal for the U.S. equity markets. So be careful here. I'm not saying go running in and short the market tomorrow, but we want to have context. Context matters. What we've gone over tonight is the valuation of the market. The valuation of the market is at nosebleed levels. Yes, the technicals look good. No doubt about it. I will argue that while the Qs closed up Friday afternoon, the problem is that they're still laggards. They still have not really threatened to take out all-time highs. That could change this week, and we may need to lighten up on our shorts. Other things that we've talked about, the headlines, oil tankers being blown up in the Indian Ocean or the Red Sea. What does that mean? It means inflation. Ukraine now getting more aggressive deep inside of Russia. They're backing the Russians into a corner. What else do we have to go over? The debt. And of course, the election cycle. And now we have the un-inversion of the yield curve. This is all a major recipe for problems out there. As long as we're educated and we know what's going on out there, good. Trade at will. I just wouldn't go out too long in duration, and don't get too aggressive to the long side. And have plenty of cash on the sidelines. Like Warren Buffett, he's got his biggest cash pile in history on the sidelines. What does Warren Buffett know? Let's do some chart requests, and we will call it a night. Let me go back, get to the post. All right. Where is it? I wanted to go over seasonality of wheat. All right, let's take a moment here. This is a weekly chart of wheat, WEAT. This is not a futures contract. This is a ET, I guess they're calling it ETV. I really like this. Outside reversal bar. We already went over this, but I want to take a look at it. Oh, by the way, I didn't go over this. For you folks that are not currently using TrendSpider, they're having a Labor Day sale. Go over to the TrendSpider space. Use this link. Don't use my discount code. Don't use it. That only gets you 35% off. They're giving you 63% off, but you got to do it, I guess, by the end of business today or late tonight. So same thing. So head on over, TrendSpider, 63% discount code. If you're watching this on the replay, YouTube, Twitter, I'll post a link so you can take advantage of it as well. All right, back to wheat. Seasonality. September is favorable. October, very favorable. So we're going into a seasonally favorable period of time on wheat. So it looks like a good technical setup. And it looks like a good, I want to buy here. Touch, bounce. I want to see a retest of last week's support level. And we're good to go. Let's check out corn. No, well, we do have a breakout here on corn. We broke out again. We set up our alerts to get a retest. And I may not trade this vehicle, but I may trade the futures contracts or sell premium, sell puts here. I kind of like that idea of selling puts here. Soybeans. Oh, by the way, I didn't go over seasonality on corn. Again, very similar as what we saw with wheat. We rally a little bit less positivity than wheat in September and October. But we're coming off of, this is pretty consistent. We've had a bear market in soybeans, in corn, in wheat. So it looks as though it makes sense that we're probably going to get a good rally for the next couple of months. Could be short, but a good rally nonetheless. Bob, will you be live in the public forum during the trading day? Yes. I'll have it on mobile. Yeah, I will have access to it. Yes. Mobile or laptop, either one. Soybeans. You know, I'm not loving soybeans as much as I like the, I want to get rid of these alerts. At least this one. As much as I like soybeans, wheat and corn, the one thing I will say about this trade that I like better than wheat and corn is the seasonality. Remember, the seasonality on wheat and corn, you had 2 up months, where with soybeans, you go into a stretch of 3 months of positive returns on soybeans. But I don't like the technicals as well here as I do on corn and soybeans. Let's go. The month is over. Let's check out the monthly charts. Nothing impressive here. Daily chart. Nothing. I think we need to pull back down. Now I realize why I had that alert set up here. We need to do a retest. Okay. 10 days should be good. Daily chart. I'm not a buyer here of soybeans. All right, let's take a look at other requests that were out there. Okay, we have for Sean, SILJ. This is Amplify junior miners. These are the junior miners, so obviously more volatile than the senior miners. So it's a mixture of good and bad here. Net, longer term good, short term bad. So let's talk about it. So first thing I want to point out is that we're coming out of a Bollinger Band squeeze, right? So you had a tight neck, Bollinger Bands trading inside the Keltner channels. What happened? It fired off. Now what we did is last month, we pulled back, tapped the 20-period moving average, and rallied off of it. This is the simple moving average. And that's good stuff, but we closed down on the month. That leads me to believe that we probably have a little bit more consolidation to go. Makes sense because now we're pulling back in the futures about 0.75 of a percentage point right now. Let's drill down further. Weekly chart. We may do another retest. We broke out here the week of August the 19th, and I'm looking at this on the side of my eye here. Silver miners through November, very, very bearish period of the time. So I see no rush here to get aggressive of the silver miners. I'm going to bring up GDXJ. This has got a little bit more data, but seasonally not favorable. So September is the worst month out of the year for the silver miners. So I would avoid them right now. Avoid them like the plague, especially with the dollar and the 10-year yield moving up higher. And we own both of those names, GDXJ and the SILJ, but they're highly correlated. The silver miners are more correlated to the gold mining stocks than it is to silver. So I would avoid this right now. We'll keep an eye on it as we do every day, but I would avoid it right now. VST for Trader Isaac. It helps me so much to have these organized. Vistra Corp. Let's go to a monthly chart. Given that we're, oh, this is pretty. This is pretty. Very, very nice. I'm going to use support at the opening body here back in April. It's around $70 a share. We did not break out last month. I want to be more bullish on it. I love the monthly setup. There's one thing that bothers me is this. These dead cat bounces, bear flag setups, call them what you will. Could we be having another one right now? Yeah. Seasonality-wise, we're in a very, very favorable period of time. The best part of the time was in August. September, October, okay. But November is when it really picks up. So let's talk about, I think what you need here is what I always go back to. Whenever I have a situation like this, where I love a higher level time frame, such as with the monthly chart, and I always say to myself, what are you looking for? When do you want to get bullish on this? What's the trigger? What's the mechanism? You need a higher low. You need a higher low. And what I would do here is I would be looking at my stochastics, seeing if they're rising, and if I have a higher low, which we do not yet. They are rising, but there's no higher low yet. I would look for a pullback here and then a reversal. Or a pullback, even if it breaks this support level and closes there, it's fine. As long as we're able to do this. Let's get rid of this and say, okay, what I need for this stock to earn my investment dollar is this. I need for it to close above this pivot point at $89.23, $88.23. Till that time, I will watch and see whether or not we get an orderly pullback, tap, 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 maybe nibble if it gets all the way down to $70 a share, which is feasible. It would still be a higher low if that was the bottom, and then you rally back and close above 88.23. I mean, I think that that's a reasonable expectation for what you should expect out of the stock. But there are other support levels here as well. 76.50, good support level. So those are the ranges between 76 and $70 a share. I'd be looking to buy VST. Bob, the stream is good on my PC. This is from TZ Burton. The stream is good on my PC. I can ever share my phone app to my TV with my Apple TV. Okay. I'm glad people are getting creative with this. That makes me happy. All right. I think that's it. I'm not seeing anything stray requests in the comments. Folks, thanks for being here. Thanks for making this first big live stream, actually Monday night live stream, live in the forum. A really good one, a special one. We had a good time here. Franklin, you're very welcome, and chat with you tomorrow. If you're watching this on the replay, please head on over. Use the link below on YouTube, above on Twitter. Join. It's free. Join this community. It's different than X. It's different than StockTwits in terms of we don't want the negativity towards people putting out posts. You can put out the same post. If you want feedback on your posts, feedback on a chart, you have an opinion, express it. The one thing that we don't like here is people bashing other people. If you have constructive criticism, fine, give it. It's all in the delivery. That's what makes this platform different. It's got the same technological means as those other platforms, except we expect the quality of the conversation to be higher. So that way people can put themselves out there that are inexperienced and they're just looking for some support, not a bashing. So that's why I created this. Sign up, it's free for now anyway. And I'll see you on the other side. Have a profitable trading week and happy Labor Day to all. Be well. Sean, have a great night.